You make a few winning trades, your account's in the green, and suddenly you feel like the market's personal chosen one. You start thinking, I've cracked the code. But here's the truth. That feeling, that's not mastery. That's overconfidence bias. And it's the psychological trap that can turn quick wins into big losses. Let's talk about one of the most dangerous enemies hiding in plain sight: your own ego. In trading, overconfidence bias is when you believe you're better than you actually are at predicting the market. It usually shows up right after a streak of wins. Your brain says, "We've got this." But in reality, you might just be riding a lucky wave, catching a favorable trend, or benefiting from broader market conditions you didn't cause. The danger? Overconfidence makes you take bigger risks, ignore your trading plan, and underestimate the possibility of being wrong. It's like walking a tightrope, feeling stable, then deciding to try a cartwheel halfway across. Why is this worth talking about? Because overconfidence bias quietly destroys trading accounts every day. And it doesn't only hit new traders, even seasoned pros fall for it after a hot streak. In this episode, we'll break down what overconfidence bias really is and how it works in your brain, the real-life traps traders fall into because of it, how to spot it before it sabotages your trades, practical steps to keep your ego in check while still trading with confidence. And yes, there's a difference between healthy confidence and destructive overconfidence. Let's make sure you know which one you're trading with. Before we continue, I want to thank the sponsor of today's video, Noesis. Noesis is a platform built specifically for traders who want to level up their consistency and mindset while avoiding mental pitfalls. It gives you tools like a daily mental check-in, a trade journal, and an emotion wheel to track your state while trading. On top of that, it includes structured playbooks, which are strategy checklists that you can go through before and after each trade, plus a playbook marketplace where you can explore proven strategies from other traders or share your own. If you're serious about developing the psychological edge that most traders ignore, Noesis is worth checking out. You can get started today at noesis.zone. Link in the description. What overconfidence bias really means. Overconfidence bias isn't just thinking you're good. It's a systematic error in judgment, where you overestimate your knowledge, your accuracy, or your control over outcomes. In psychology research, it shows up in 3 flavors. Overestimation, believing you're more skilled or knowledgeable than you actually are. Overplacement, thinking you're better than other traders. Overprecision, being way too certain about your predictions. In trading, this might sound like, I know, Apple's stock is going to pop next week. I can outtrade 90% of people in this market. I don't even need a stop loss. I've read the charts perfectly. The problem is, markets are chaotic. You can make a perfect call today and be completely wrong tomorrow, but overconfidence blinds you to that randomness. Why your brain falls for it. Your brain loves patterns and rewards. When you win trades, dopamine, the brain's reward chemical, fires off like fireworks. It feels good, so your mind builds a quick narrative. I'm good at this. I can do it again. The trouble is, short-term success often has more to do with probability than skill. If you flip a coin and it lands heads 3 times, you might feel like you've got a knack for flipping coins. But the odds haven't changed. In trading, especially during bullish markets, it's easy to mistake good timing for great skill. This is how traders start ramping up position sizes, skipping research, or trading asset classes they've never touched before, because they believe they can't miss. Real examples of overconfidence in action. Imagine this: a beginner makes 5 winning trades in a row on tech stocks during a market rally. Instead of recognizing the market trend, they think their stock picking skills are elite. They double their position sizes, and one bad earnings report wipes out all their gains. Now imagine this: an experienced Forex trader nails a few trades after news events. They start thinking they can predict central bank moves. They go all in before a major announcement, only to see the currency pair whipsaw in the opposite direction. Also, same for a crypto trader rides a meme coin wave and triples their account. They assume they have market intuition and start trading volatile assets without research. Weeks later, the bubble pops, and they're left with a fraction of their portfolio. Common pitfalls caused by overconfidence. Overconfidence doesn't usually announce itself. It creeps in quietly, then shows up in your trading behavior. Here are the most common ways it sabotages traders. Oversizing trades. You increase your position size beyond your usual risk limit, thinking the setup is a sure thing. This amplifies both potential gains and potential disasters. Ignoring stop losses. You tell yourself you'll exit if things look bad, but that moment comes and goes while you're still hoping for a turnaround. Overtrading. Riding the high of recent wins, you start taking more trades than you can realistically manage or analyze. Skipping research. Why check the fundamentals or news? You're convinced your read on the chart is flawless, wandering outside your expertise. Suddenly you're trading commodities, crypto, and Forex all in the same week because a trader of your caliber can handle it. Each of these moves puts you at greater risk. The worst part? Overconfidence. Makes you blind to that risk until the damage is already done. How to keep confidence without crossing the line. Track your trades. Write down not just the entry and exit, but why you took the trade. Over time, you'll see whether your wins were due to skill or market conditions. Respect your plan. Even after a hot streak, stick to your risk management rules. If your max risk per trade is 2%, don't push it to 5% just because you're feeling it. Use stop losses. Think of them as seat belts. You don't expect to crash, but you still buckle up. Seek outside feedback. Share your trades with a mentor or trading community. Other eyes can spot when you're getting cocky. 5. Practice humility. Remind yourself that even the best traders lose. Paul Tudor Jones, one of the greats, says, "Don't focus on making money. Focus on protecting what you have." Takeaway. Overconfidence bias isn't just about thinking highly of yourself. It's about losing sight of how unpredictable the market really is. It's that quiet, sneaky shift from "I have a plan" to "I can't lose." The danger is that once your brain locks into that mindset, you stop respecting risk, stop questioning your assumptions, and start trading on feelings instead of facts. The goal isn't to kill your confidence. You need confidence to take trades in the first place. Without it, you hesitate, second guess, and miss opportunities. But confidence without discipline is just ego dressed up as skill. The traders who survive and thrive are the ones who can win big and still act like they might be wrong on the next trade. So here's your checkpoint. After a hot streak, pause. Look at your last few trades. Were you following your rules or following a rush? That one moment of honesty can be the difference between keeping your gains and giving them right back to the market. If this episode made you think, "Wow, that might be me," then you're already ahead of most traders, because awareness is the first step to fixing it. Overconfidence bias is tricky. It feels good. It feels like momentum. But that's exactly why it's dangerous. So here's your challenge. Over the next week, keep a mental ego check. Anytime you feel unstoppable in the market, write down what you're about to do and why. You'll be surprised how often the why isn't part of your trading plan. If you've ever had your ego hand you a loss, drop the story in the comments. We've all been there. Like the video if you picked up something useful, and subscribe so you don't miss the next episode in Trading Psychology Pitfalls. Next time, we're tackling the fear of missing out. How FOMO can push you into trades you never should have touched. Trade smart, stay humble, and I'll see you in the next one.